Yes, you can control stocks at 50 to 70% of their current value and capitalize on their full price increase over time in your tax-free saving account. How? Let's dive in. Welcome to the Real Estate Tax Tips channel. We aim to be your Google Maps for financial freedom. Now, what you are about to see is how you can control stocks for a fraction of their full value, even as much as 50 to 70% of their current market price. I'll explain which stock market instrument the government allows you to use to implement this strategy tax-free. You'll see a couple of examples on how exactly this works, and I'll make sure you know which pitfalls to watch out for. And then I'll show you why it's so powerful in the long term as well. Okay, ready? First, if you haven't subscribed yet and you're eager to dive in, subscribe to this channel right now. That way, you see every video we pump out. Then turn on notification so you get alerts the instant videos go live. Investing in your TFSA is one of the only ways the Canadian government allows us to earn money tax-free. So why wouldn't we take full advantage of that opportunity and maximize our return in TFSA account? But I will say this, everything you earn in your TFSA is 100% tax-free. That means no capital gain tax, no income tax at any time. So we want to use that TFSA to its fullest potential. And one way to do that is to buy deep in the money calls in your TFSA. This allows you to control 100 shares of a stock at a fraction of the stock's price, but you still get the benefit from the full value increase of the stock over time. But what are deep in the money calls? Well, how do they work? And how do they actually let you control stocks so cheaply? Let's look at all of that and then we'll get into some examples. Okay, deep in the money calls are option contracts. And stock options are promises to buy or sell 100 shares of a stock by a specific day if the stock price hits a specified price. If you are buying that promise, you pay a small premium upfront. If you're selling, you collect that premium immediately. If you watch our previous video about selling covered calls in your TFSA for tax-free cash flow, then you'll be familiar with this concept at least. In this case, we are buying call contracts. We're buying the right to buy someone's shares by a specific day at a specified price. For that right, we pay the option seller a premium upfront. Let's say you like a company and you think it's a good time to invest in them, but maybe you don't have a lot of cash ready, or you just don't feel like paying full price for the shares. So instead of buying shares outright, an alternative you have in your TFSA is to buy a call contract. In this case, you want to buy a deep in the money call. You're buying the right to buy shares of a company for a specific price, also known as the strike price, by a specific day, the expiry date. What makes a deep in the money call special is that you now have control over 100 shares of the company, but you have only paid the premium for the call contract. You haven't actually paid out the full price for the shares. When you buy a call contract far enough into the future at a low enough strike price, the call contract price will actually follow the price movement of the stock fairly closely. For example, if TD Bank goes up in price by $1, the call contract on TD Bank can go up by as much as 99 cents. If you bought 100 shares in a company at $10 per share, your total cost is $1,000. If that stock price increases to $11, you've just made $100. You invested $1,000 and made $100. That's a 10% return on investment. Pretty good. Now, let's look at how different it is when you buy a deep in the money call on that same stock. Let's say you choose a strike price of $5 and set the expiry to 500 days from now. That gives you plenty of time to make a profit. Let's assume the premium for that call is $5 per share. Your upfront cost is only $500. When the stock increases to $11, the value of the call contract would increase to $5.95 per share. You just made $95 on that contract. You invested $500 and made $95. That's 19% return on investment. And there you see the power of deep in the money calls. Let's look at a real-life example to see how well it could do. Let's say you like Toronto Dominion Bank. The stock ticker is TD, and you think it's good time to invest in them. But maybe you don't have a lot of cash ready, or you just don't feel like paying full price for the shares. In this case, you could buy a call contract at a strike price of $70 that expires in January 2023. That gives you over 520 days as of the day of recording of this video to let TD appreciate and then cash out. For the right to buy TD at $70 by January 2023, you would pay a premium of $16.35 per share. Because there are 100 shares in every option contract, your upfront cost is about $1,635. At the time of recording, one TD share costs $86.14. So instead of paying $8,614 outright for 100 shares of TD, you could buy the call for $1,635. That's an 81% discount, and you still benefit from any price appreciation between now and the end of the contract. Obviously, you want TD to be worth more by January 2023. Let's say the share price goes up to $96.14 in the next year. That's a $1,000 gain for 100 shares. If your call contract appreciated by 95% of that value, your gain on the call is $950. If you like that profit, you could sell your call back to the market and realize $950 profit. If you own the shares, your return on investment was a gain of $1,000 divided by the full cost of $8,614, which equals to 11.6%. If you invested in a call option on TD Bank instead, the return on your call is the $950 gain divided by your upfront premium investment of $1,635, which equals 58.1%. That's efficient use of your money. Now, here's the beautiful part. Usually, if you were to profit like that in a personal account, you have to pay capital gain tax on the profit at the end of the year. But because you made that profit in your TFSA, it is completely tax-free. Deep in the money calls are just another way to efficiently invest in your TFSA and maximize your tax-free returns. Now, I can hear your questions already. What happens if the stock drops? What happens if I hold the stock until expiry and it's below my strike price? Can I collect dividends while I hold the call contract? Let's walk through each of these scenarios. What happens if the stock drops? When the share price increases, the value of the call contract goes up. When the share price drops though, the value of the call contract moves down as well, in which case patience is a virtue. If you truly believe in TD Bank, then Warren Buffett's first rule of investing is never lose money. Wait until the price rebounds. That's a part of why the expiry date is so far in the future. It gives you time should the trade not move in your direction at some point. This is why it's good to have an exit strategy planned ahead, such as a set profit amount or return on investment percentage. Choose a price or a certain profit amount, say $500 or $1,000, and when you've made that much on this one trade, sell. Take your profit and buy another deep in the money call. Taking profit is very important. It saves you from any surprises because we all know that stocks don't keep going up forever. There are corrections and pullbacks, so if you like how much profit you're seeing, sell the call back to the market and lock in your win. What happens if I hold the stock until expiry and it's below my strike price? This is the worst case scenario. Now you have 3 options. Number 1, you can exercise your right to buy the shares. Number 2, you can sell the call at a loss. And number 3, you can roll the call to a future day and essentially hope to make money down the road and cut your loss. Now, let's go through each option one by one in detail. The first option is to exercise your right to buy the shares. If you exercise your right to buy shares of TD Bank at $70, you're buying at a loss. However, you now own the shares and can hold them until they recover. Keep in mind the premium you pay, $16.35 per share. The premium plus your strike price equals your break-even price. In this example, $16.35 plus $70 equals $86.35, and that becomes your new purchase price, new break-even price. So wait until the price of TD is over $86.35 to recover the premium you pay and ultimately make money in the end. Sometimes though, you just have to bite the bullet and take the loss. If you don't mind holding the call for longer term, you could sell the call but immediately buy another deep in the money call further out that's known as rolling. When you roll the call, you will first realize a loss, make a note of your loss, and make sure you don't sell the new call until you've made that loss back. Can I collect dividends while I hold a call contract? Well, this is one major drawback of deep in the money calls. You can't collect any dividends because you don't technically own any shares. If you're building a dividend portfolio, deep in the money calls won't achieve your goals. But if you're looking for efficient growth, the deep in the money calls might be worth investigating. How does buying deep in the money calls accelerate your TFSA? It's all about the velocity of money. How fast and hard can your money work for you? The more trades you make, the more chances for profit. When you play them well, deep in the money calls can yield a better return on investment. Now, obviously, this also is up to your risk tolerance. You may not want to be in and out of trade every few months, and that's completely okay. How you make money with deep in the money calls is completely up to you. But at least now you know about one other way to efficiently use your TFSA money. When you finally decide to start withdrawing income from your TFSA, your profit could potentially be a lot higher than if you had just bought shares over the years. And this is the big picture goal. The more money you can make in your TFSA, the more tax-free income you can draw on when you are ready to retire. Well, we cover a lot in this video. You learned about deep in the money calls, you saw an example of how a deep in the money call plays out in real life, I explained what happens to your call contract if the stock goes up or down, you learned about what to do if the call goes against you, and I show you how deep in the money call accelerate your growth in a TFSA account. And if you found this information useful, hit that like button to let YouTube know that this was worth your time. If you want to learn more about tax-free saving account or tax tips in general, make sure you subscribe to our channel. If you have any questions relating to this video, make sure you comment below and I will personally respond to all your questions. One last thing, we are preparing a TFSA Playbook to provide an overview of how TFSA works in Canada, the type of investments you can do to maximize your return, and landmines and mistakes that you probably want to avoid. This TFSA Playbook will be available by the end of September. If you want to pre-order it now, visit tfsaplaybook.ca and download it for free. Okay, that's all. Thank you for watching.